I sort of know Jeff's thoughts, but maybe, maybe Gerard, let's start with you, because I have no idea what you're gonna say exactly.
Okay, thanks very much. My name is Gerard Getz, single family office principal based here in New York. What scares me?
Speak in the microphone.
Hello? Okay, what scares me? Bad operators. I mean, there's a lot of them in the real estate space. I think a lot of them got washed.
I didn't let you introduce yourself.
Okay.
That might help the context. So if you stop pause on that, you could.
Yeah, sure. I'm a single family office principal based here in New York. My background is public markets and then more private markets the last 10 years. So in the real estate space, where I've been investing last few years, mobile homes, industrial and industrial last mile and multifamily. Some things that are scary to watch out for is risks, I guess, is just like any investment, your sponsor, their track record, their competence, obviously low rates, anyone could make money for a long time. This market is more challenging, but you can definitely make money in this market, even if you're buying stuff over the last few years, if you underwrote it correctly. So, the operator, the sponsor, their story, their competitive edge. I think the scary other things are insurance is out of control everywhere. Obviously, the worst in the coastal states, but it's a problem everywhere, and operating costs are just up in general, and there's inflation. Other scary things. I'm not a super fan of like Class A. I'm usually investing in stuff that I would never want to live in, but the supply demand is better for those assets. There's obviously been a ton of development, which is now getting delivered. Last year, this year, next year, it's going to weigh on the top end of the market. Got to be careful of that. What am I excited? And now, what do I like? Is that second part of the question? Look, values are probably down 20%, 25%, depending on where you look. And, there's interesting stuff to do in terms of what I'm seeing and where I've been transacting is like, there's a few things. One is distressed stuff as lender takebacks, and you have something that you can buy for the value of the debt, and it's really cheap. It's one opportunity. There's going to be more of that the next couple of years. I think the other opportunity is just small balance stuff like $2 to $15 million equity checks, and trends and not super levered. So LTVs of like 50 to 60% in mobile home and industrial outdoor storage. I think there's opportunities to get yield on cost north of 8% in those spaces, and I think that's pretty attractive even in the current rate environment. Yeah. Oh, it's all that what scares me. Yeah. Well, I listed, so I'll go to the next.
Okay, let's keep it going. May, you wanna? I know you wear a couple hats. How do you see the world today?
Well, I guess I'll just start with a quick introduction. I'm at a single family office, and I've been investing in real estate on behalf of our family for the past 10 years. What scares me, kind of keeps me up at night now, is it seems like in the past 6 months, a lot of brokers in the city and kind of in the country have been pushing aggressively office buildings. And it seems to be the strange coordinated effort. And it seems to be a little bit more out of desperation than genuine good opportunity. And if you kind of look a little bit more into it, it appears that about $2 trillion in commercial real estate loans is coming up to maturity in 2025 up to 2027. So I think this is actually quite risky, considering a lot of these loans are also held by regional banks. And I think with some of the problems we've seen in the past few years with First Republic and a lot of liquidity issues, I think this could really become a bigger issue. And we want to see kind of how it plays out in the next year. So that's kind of what scares me, with just a lot of, I think, liquidity issues with a lot of the loans that's happening now.
Do you know the geographic dispersion of the 2 trillion?
That's in America. Yeah, so I think about
Okay.
1.2 trillion of it is actually up for maturity in 2025, and the remaining 2026 and 2026 and 2027.
Inside America, do you know the general breakdown?
I think also office recovery has been different in a lot of different places. In New York, it's been completely fine in Class A. They've been getting rates higher, I think, than ever. And then Class B and Class C has suffered quite a bit. But New York City has more office real estate than a lot of metropolis have, even real estate in general. So like we have so much vacant real estate and vacant office real estate in New York, more than some other cities even have office real estate available. So I would say a lot majority of it is in the Northeast.
I teach you up, Jeff.
Jeff Keith, Fairbridge Asset Management. We're a real estate private credit fund, bridge lending, which I spoke on earlier. My background is I spent 20+ years in leveraged finance on the street and flipped to the buy side and found real estate. I would say risks, rates and tariff uncertainty is a common theme. More importantly is real estate's local. It's never, that's the adage we use. You can have a down market in the Smile States right now in Las Vegas, parts of the Southeast, but the other areas are doing really well, Midwest and the Northeast, especially Ohio. And the reason the Northeast we like.
You love Ohio.
I love Ohio. And the Northeast, which, they let a lot of tax abatements expire during COVID, which then there was no building. And so you basically have a shortage of housing, not only across the country, but also in the Northeast. So we still like the Northeast. Fannie and Freddie Mac have just come out with numbers, and it's anywhere from 2 to 7 million of shortage of housing. And that's really rental units. George, you touched on, we are in the Class B space. It's not where some of us would live, but it's workforce housing. And that space tends to be a little bit more recession resistant. Finally, we really value the sponsor. When we walk into a developer, we sit down and ask them what their 1, 3, and 5-year business plan is. We don't want to just do one loan. We want to work with borrowers over the next 3 or 5 years. And those borrowers, we actually ask the due diligence as well. Who's on your team? Do you have an infrastructure in place? 65% of our loans right now are with repeat borrowers. And you really don't miss on valuation in real estate. You can, with all the metrics out there, you can get within 5%. What we value when we look back at our defaulted loans, it's all on execution. It's, we like to work with borrowers who have been through COVID, been through rate rises, been through cost overruns, supply chain issues. Building's not linear. There are going to be some bumps in the road. So we want to work with lenders who have been through that process. So that's a risk. So we go out and visit we just hired somebody 6 months ago to go visit all of our sites rotating to make sure, keep a pulse of our developers and figure out where they need help. And I would say underwriting is really critical. We brought an institutional approach. The founder of our firm also ran a family office and sat in that seat that many of you did. Sat at an asset manager, and we have credit memos that are 30 pages long. We have weekly credit meetings, weekly asset management meetings. We have an underwriting team. We have a desk of analysts. So you want to bring that approach to your firm and try to due diligence everything you can.
I have another general question, but anybody can ask a question. My general question was, I told the panel, share an insight that you don't think we're focused on, that we should know about. But I know that there are a lot, the great thing about real estate is everyone's here is in it, right? So you all have if you have an insight, what scares and excites you, chime in. But is there something that you think, sometimes we call them fun facts or interesting facts, but there's something that I think we should know about? talking to you, yes.
I don't know if it's like a secret or what, but I just think cycles don't matter as much when you look for real inefficiencies. And when I'm trying to invest in this space, I'm looking for like sellers that are selling for non-economic reasons, either family succession things or just other forced
How do you
sales.
access that? How do you find that?
You just have to keep searching and like networking and wait around the hoop for things to happen.
Around the funeral homes or something? What do you-
No, no, it's just a lot of this stuff is held for a long time and by families, and some of the stuff, especially the smaller transaction sizes, like under 20 million, they haven't been efficient in managing the asset. And when the patriarch wants to pass it down, and maybe there's a problem with dividing it and they just need to sell it, or it gets passed down, they want to sell it, there's just an opportunity to reprice, especially some of these, like inflation was so rampant in the last 3 or 4 years, you really had to adjust rents 30% or you're, dropping rents on a real basis. And some people didn't raise rents. So that's an opportunity. You can still find stuff like that out there.
Back to how you're finding it, then. How about, who wants to take the next? This general theme and insight or fun facts.
Well, I think a lot of people put a lot of focus on the real estate interest cycle, but we've kind of put a lot more focus on loan maturity cycles, especially since in 2018, 2020, a lot of these loans were underwritten at 3%, 4%, and now they're coming up for refinance, and they have to refinance at 7 or 8. I think a lot of these are going to become distressed, especially if you combine with the fact that in some cities, like in Arizona, in Texas, in Philadelphia, rents haven't increased, they've actually decreased, and the performers were written at 3 to 5% rent increase over time, and that hasn't happened for some of the cities. So I think you're in a situation where there could be forced liquidity calls from the bank. And I think that's a good position for like single family office investors to really get, I guess, a good bang for your buck. So that's something I've been looking more and more into, just when loan cycles are maturing.
I would say, having worked in high yield and looking at all fixed income products, I don't think I've ever seen a product in the bridge lending space in the middle market where you have consistent returns, not just us, but there's 8 or 9 fund managers out there in the bridge lending space that we really like. The returns might be lower. And I think you can get consistent returns. I think insights people don't realize in this middle market space that we get first lien, personal guarantees on these loans, and we're first mortgage. On the capital raise side, there's an insight.
But there's some of you get caught up. Some of your peers go over their skis.
But like I said, there's some quality bridge lending managers. We get asked all the time. We like you. Who are the 3 other funds you like? And we're very collegial, and we recommend funds that we compete against. I think another insight on the capital raise side is a lot of the independent RIAs, the sort of 2 to 20 billion world, which is where we focus on, they don't have access to fund managers, and they like the alternative investment space. And we're seeing a huge transformation in the alternative investment space. We're seeing fintech companies pop up to help handle that subscription process to invest in it all. The RIA world, the independent retail investor, has been kept out of that, and they want to create more alpha in their portfolios. So we're seeing interval funds, startup, fund of funds. We're seeing feeder funds inside of $2 billion RIAs who then put 10 managers in it because they don't want to have exposure to one manager.
I thought one of those RAs was on the Zoom, but it's not on right now. I don't see it, Rich. But I agree with you. We love RIAs.
So the capital raise space is taking on new paradigm shift.
All right, let's open it up. Questions,
I have a
comments?
question.
1 second, please. Well, she was on a panel.
No more time.
Nice to see you all, and thank you, Mark, for hosting this event. I think this is a really insightful event. This was my first I attended personally, and thank you everybody else. So the elephant in the room, which nobody has touched, at least at the conferences I've gone to, is especially in relation to real estate, and I'm in real estate, is government regulations, bureaucracy, and I don't know if you call court system, but unfortunately, whether you like it or not, I'm involved in the court system directly, and nobody has brought that up. And when Mark said, what keeps you up at night? Well, first of all, nothing keeps me up at night. Thank God, I'm doing very well. But I'm concerned with the as far as the system, as far as bureaucracy, getting worse and worse. So could you just elaborate?
Jeff did.
Jeff said that's why he's in Ohio, partly because he can get his money back in 60 days.
Right, he did mention that, right?
Yeah, I mean, I don't want to take too much time, but just really quickly, when we look at a loan, we price out what state it's in. Is it judicial, non-judicial? And if it does go through foreclosure, how long is it going to take for us to get our money back? We do that on every single credit memo. So luckily, we have 3 lawyers in-house that know bankruptcy and foreclosure laws because they're different in every state. So we do look at it.
I would say when it comes to bureaucracy, a lot of that is, especially in real estate, hyper localized. So depending on which county, your relationship with the city council and the department of buildings in that city, it changes drastically. So I think that's why sometimes it's very good to specialize your portfolio instead of diversifying, because then you can really bank and build stronger relationships in the county and potentially do private public city partnerships and have that work in your favor instead of against you. So I think that's why one of the reasons we like to specialize in certain geographic regions.
So I had a quick question.
Go ahead.
How much of distress are you guys seeing in the marketplace?
I think Macy's distress coming.
I think another interesting about, I guess, distressed loans, kind of to your point earlier, some of the best ones are kind of pre-distress or at the bank level. So you have good relationships with regional banks. You kind of get first dibs before they kind of go fully distressed. The ones that you see public distress or going to auction or foreclosure are generally, yeah, that hasn't quite happened yet on a large scale. I think with what I was saying earlier with the loan cycles maturing, we might see more of that, but I think currently it's still fairly stable. But I think there is some pre-foreclosure action happening at on the regional bank level.
One second, Bill. Since you were on a panel or you spoke earlier. Glenn.
Well, I think, Gerard, you were gonna say something.
Okay, yeah, Gerard, go ahead. No, I was just gonna add to that. I think that's right. I think what I'm seeing is there's stuff distressed. Everyone knows it's distressed. It's, new people want to take over and certain people have the in with the lender and they're just talking to them for like 6 months and the lender's trying to, do the right thing and kick the can. There's been a ton of that and there's going to be more, but eventually the lender's just like, this is hopeless. And, they'll just sell it for the value of the loan, but that it's either a deed in lieu, so it's not going to hit the court or it hits the court for like a day, but there's a buyer. So there's not a lot of stuff just like, out there in the ether distress. It's kind of being cleaned up immediately, aside from office, which is just, its own disastrous animal. But
Hi, Glenn Veronic. Thanks for all the great information on the panel. Really appreciate that. I'm in real estate as well. And my question relates to, it seems that more and more, given the capital markets more generally, we're seeing an eye towards liquidity. And are you seeing in the private equity side for real estate any interesting structures or creative structures that maybe deal with the liquidity question at the get-go?
I'll start. I mean, I think there's been like some innovation, but I wouldn't call it great. I think you see some of the active retail targeted syndicators like creating REITs and trying to give people liquidity, and there's like valuation, debates around that and appraisals. And I don't know, like if I was involved in stuff going into that, like where I was getting appraised. It just I'm not, but it's not a great situation. But I'm not seeing any like anything really new beyond that I call out.
We just, if this answers your question, we just did a co-invest deal, and what you're seeing is a loan that needs to be refinanced.
Use the microphone.
A loan that needs to be financed, and you tranche that loan into 3 tranches. You can do an A note, a B1, and a B2. So it's a waterfall, and you're starting to see some of that out there in the sort of the restructuring side of the market and the co-invest side.
Bill's got.
No, I feel like I maybe haven't been around long enough to have anything to compare to. So I don't have much to add.
So, it doesn't sound like any of you are.
Bill, that's okay.
Oh,
Go ahead,
oh,
let
go-
me-
go
no,
ahead.
Bill, you go. I just was wondering if you guys have been able to secure any solutions to speed up the process using new technologies that are coming out, in particular with the underwriting part. Do you require appraisals to be done or environmental phase 1, phase 2 stuff?
Well, I would say with appraisals and kind of environmental, that's normally done by like an entity or a government-like entity. So in those spaces, no. But I would say with AI has helped a lot the operations or even due diligence and some of the perform the math behind it. But appraisals and in that space, no, it's normally like appraisal agency and they have some vested power.
We are seeing on the valuation side, we use that as well for every property, but also we are using AI on the due diligence side. We're also talking to a couple providers to how do we streamline our underwriting process using AI. We were just talking to one of the gentlemen in the audience about that. So we're definitely trying to keep up on technology, on the underwriting, on the origination.
I'm using AI quite a bit for just due diligence purposes, just speeds everything a lot and it'll uncover negative information that is obviously not being disclosed by someone marketing something to you. So
Entire room is. Any other questions? Particularly this real estate, any segments that you guys are excited about? Of course, you're so excited you don't want to share it.
I guess, 1 second. So, it doesn't sound like any of you are specialists here, but you all look at real estate. We keep hearing, we heard it 3 times today, hear it all over. Housing shortage, housing shortage, housing shortage, okay? And so I don't know if Fairbridge does like construction loans or anything like that. Yeah, you do, okay. So if there's such a housing shortage, then other than the 20 huge public home builders, which are easy to see, I don't see a lot of real estate people in our sort of circles that are doing anything more than maybe a multifamily or something like that. It's not, nobody's like trying to jump on this opportunity. Is there a reason why not?
Not in Ohio.
Okay,
No.
there's 49 other states. No, just maybe, am I missing something?
I mean,
You sort of touched
I
on
can
it.
speak to that.
Who else?
I got a bunch of service guys to all those builders, right? The HVAC guys and mechanical and plumbing and all that
So
stuff.
you're doing HVAC roll-ups?
They're all pivoting out of multifamily and all into residential and industrial, for whatever reason, in different regions of the country. So I've got them in the DC market, in Arizona, the Southeast. I got them in Ohio, in Columbus, beautiful town. And yeah, no, all of them without fail, in all the regions are pivoting out of multifamily for whatever reason.
I would just echo real estate's local. So just because you're seeing no construction in some
Yeah, they're-
areas.
Consolidated, but they come from somewhere.
Yeah, well, it's Fannie and Freddie, and there's a shortage of, let's pick the middle, it's 4 million, and that's rental units. So rental units is very different than condos.
I know, I said both.
Yeah.
Single family, could be rental, could be anything. Anyway,
I would also say I think in a lot of cities it's actually an oversupply right? In Philadelphia or Arizona or Texas, where if they build a lot with a lot of incentives over the past years, rents have actually decreased in a lot of these places. So I think, yeah, to your point, it's definitely very localized, depends on where there is a housing shortage to really, I guess, address your question. But in a lot of places that we've seen a lot of activity in the past 5-10 years, just don't have a housing shortage.
Yeah, one thing to add is New Jersey is the second growth market in the country in terms of real estate right now. Believe it or not, because the 5 boroughs, because all of that
It's
building didn't get done for 3 years, you have police officers, firemen
Not Connecticut.
moving to Paterson, New Jersey, and commuting into the city.
So I'll tell you that. I'm from Columbus and I live in Short Hills and Milburn and Summit and these places can't make enough.
Nothing on the market in Connecticut. My daughter and son-in-law bid on 7 houses, couldn't get one. The house next to me sold in 4 days over asking.
Okay. Well, look, I'm gonna keep us on time, 3 o'clock. Next.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.